because there's many different types of taxes to consider when it comes to real estate. And it's very important that you understand what they are and how you can utilize them so that you can make the most of your tax savings. Now, I think it's important to be real and be transparent in stating that taxes is a major stress for most people. And to make it even worse, when it comes to real estate tax, those types of taxes are probably the most complex for you and for most people to understand. And because of that, it's very, very stressful when it comes down to understanding tax implications if you're a real estate investor. So I'm excited to be connecting with you all today on this talk because we're actually going to highlight the key areas and key taxes to consider if you are a real estate owner or investor. And once we understand what these taxes are, we can actually better plan so that we can minimize any of the negative impacts in terms of paying more taxes than you need to. So my name is Jamel Nelson. I'm the managing director of Nelson and Associates, where we help our clients maximize their tax savings by implementing custom tax and accounting strategies. And to give you a little bit more information about myself, I've been an accounting professional and working in the industry for over 15 years. And with that experience, I've actually worked a lot within the real estate space, specifically within the corporate America realm. And one of the first jobs that I had in corporate America was working with the largest commercial real estate company in the world named CBRE or CB Richard Ellis. And from that experience, I later joined a few of their competitors working within the corporate space as well, all the way down to the smaller family-owned real estate investor. So because of those experiences, I've pretty much seen all that you can in terms of different transactions and how those transactions can impact the owner when it comes to real estate taxes. So if you're on this call and you are a real estate owner, whether it's a primary residence that you actually live in, or if you're an investor from maybe owning a single family home all the way to a more sophisticated portfolio of properties, this message is going to be for you today. And as I mentioned, we're going to be discussing the different types of real estate taxes. So let's get straight into it. So with regards to the different types of real estate taxes, we're going to start off with the very basic concept of ordinary income. Now, ordinary income is any income that you earn and receive, and as a result, you are liable for taxes. So when it comes to real estate, the tax that you pay on your rental income, such as rents that you receive from your rental properties or your tenants, this is considered ordinary income. And it's actually going to be taxed at your regular income tax rate as the individual or business, depending on who you are. And this can really vary and depend on your overall income level. So keep in mind, if you have tenants, you're collecting rents from those tenants, that is considered ordinary income. And if you have ordinary income, let's talk about how that looks in a real life example. So let's say you have a rental property and you have a tenant in the rental property or multiple tenants in the rental property, and you collect rents from those tenants. We would calculate the total of all of those rents, and then we would subtract any of the deductible expenses that are related to that property. And the deductible expenses related to that property are going to subtract against the rent revenue received. And let's say there's 50K net income. So after we take our revenues, subtract all of our expenses, you have 50K left over as a profit. That 50K now is going to be taxed at your ordinary income level. So let's say your ordinary income tax rate is 25%. 25% of that 50K is now 12.5K. So you're on the hook for ordinary income tax of $12,500. That is your first basic example of a type of tax for your real estate investments or property. Let's talk about the second one. The second tax is your capital gains tax. So when it comes to capital gains tax, this is the tax that you pay on the profit that you make from selling the real estate property that has actually increased in value from the time when you first purchased the property. Now, this only applies if you sell the property and it is valued higher than the price that you purchased it for. And when this occurs, you now have what we call capital gains. And if you have a capital gain, you now have a tax implication, or you're now on the hook for tax, which is referred to as capital gains tax. And this is actually going to be categorized one or two ways, as a short term or a long term. And depending on short term or long term, it's just going to dictate the type of percentage of tax. So let's use a real life example in this scenario. So if you have a property that you initially purchased 5 years ago, and that purchase was $200,000, and you later for $300,000, that's a profit of $100,000. Because you sold the property for more than you purchased it for, you now have triggered a capital gain. And that capital gain is going to be taxed at either your short term or your long term. And in the situation where we bought this property 5 years ago, we now made a profit of 100K. We now will be on the hook for a capital gains tax of 15%. So that is $15,000 that you are responsible for paying for the capital gains. So that's the second type of tax. The third type of tax, when it comes to your real estate investment or property, is your property tax. Now, this is actually going to be imposed by the local government, and any individual, whether you have investment properties or if you're just an individual that owns your own house and you live in it, you're on the hook for property taxes. And the way that this tax is determined is going to be dictated and determined based on the value of the home when you first purchased it. And the key thing with the property tax is this is a bill that is going to come every single year, regardless if you have a mortgage or regardless if the house is paid off. Every year you're going to get this bill. And when you get this bill is going to dictate the amount of the bill as well as when the payments are due. And they're typically going to provide you two options to make the payments, either once or twice a year. And it's up to you on when you pay those. If you do not pay these property tax bills, now you're in a situation where you could potentially have a lien placed on your home and get your home foreclosed. So the property tax is something that is unavoidable, and this is imposed by your local government or city or county. So that was the third one. Let's talk about number 4, supplemental tax. And this is a very tricky one that most people are not familiar with or understand. But when it comes to supplemental tax, this is a type of property tax that occurs when there is a change in ownership or a significant improvement made to the property. So when you sell a property or you exchange ownership of the property, the local tax assessor office will actually reevaluate the property's assessed value. And this ultimately leads to an increase in tax, which is known as a supplemental tax. And another area to consider with supplemental tax is actually something known as significant improvements. So if you're an owner of a real estate investment or property and you have a significant improvement made on your property, such as major renovations, adding additional rooms, or really improving the building or space so that it is valued higher than it was before you made those changes, that is considered a significant improvement. And the tax assessor, again, will reassess the property to account for that increase in value. And the increase in value means more tax dollars to collect from you. So this is referred to as a supplemental or improvement tax. And this doesn't happen every single year. It typically is really seen when there's a transfer of one property owner to another property owner, which is ultimately when you sell a property or if you're doing these major renovations. So those are 4 common important types of real estate taxes. These are not all of the types of taxes, but these are the most important that I think are critical to understand, because if you understand what these are and you have an idea of how to plan and execute timing of certain transactions, whether it's a purchase or sale or whether it's a renovation, you have to factor all of these types of taxes in to your equation so that you can really gauge and plan for your tax impact and tax liability. So as I mentioned, there's quite a few more taxes to be concerned with at the city and local levels, but these are the most important ones that really can have material impacts on your individual tax situation. And as I close, I think it's important to keep in mind that real estate taxes are very, very complex. They're difficult to understand. And the reason that is because they are ever changing. They're always changing, and there's always rules and policies that we need to be up to date with. And because of this, this is why it's very, very critically important to make sure that if you are an owner of real estate, if you are a real estate investor, if you are looking to purchase, improve, or buy real estate, that you're working with a CPA, tax specialist, strategist that understands these rules and laws so that you can actually better plan and prepare for your situation. So if you're in the process of actually purchasing, selling, renovating your real estate portfolio, home, investment, whatever it is, you are what I consider to be a prime candidate for a tax plan. And in my experience, the real estate owners that actually pursue a tax plan, they actually save the most money on their tax bill. And the reason this is because we're able to work with these individuals, and these individuals are able to actually be proactive with their situation. They are not waiting until the end of the year, but they're actually planning, they're making projections, and they're strategizing on specific timing and strategies to implement to actually reduce their tax liability. And the individuals that are pursuing tax plans that have real estate in their portfolio, they are in a position where they can actually identify things such as accelerated depreciation. They're able to explore opportunities for a 1031 exchange. They're able to look to see if it makes sense to pursue a cost segregation study analysis, and many, many more opportunities. So if you, again, fit the scenario where you are a real estate investor, if you are a owner of real estate, if you are implementing any major improvements to your property, I highly, highly urge you to consider a tax plan, because now you're in a situation where you're in the driver's seat and you're being proactive with making sure that you are executing on your tax savings as best as possible. So I would say if you don't have a CPA that you're working with, or if you are not sure how to navigate this scenario, I definitely invite you to reach out to my team, reach out to me. We'd be happy to see if it makes sense for you to consider something such as a tax plan. And if you're watching this live, or if you're watching this on a replay, feel free to leave a comment in the comment section, and do me a favor, type in tax plan strategy. And again, either myself or someone on the team will be sure to reach back out to you to see if it actually makes sense for you to consider a tax plan and to see what your options are. So I hope this was helpful for you all. This wraps up my time for now. I look forward to connecting with you on the next conversation. And until then, you guys have a great day, and we will be in touch.